And welcome. Good morning, everyone, and welcome to today's interest rate webinar. My name is Jack Hogan, and I'll be your host for the event. Thanks for setting aside the time in your schedule this morning. I've no doubt the content and material covered will make it a worthwhile engagement. Before we begin today, I'd like to acknowledge the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respect to their elders past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples today. The NAB Markets team are pleased to bring you our insights and analysis around interest rate forecasts and key economic data. We will look at factors that will impact central bank policy, and bearing in mind the first RBA meeting of 2022 was yesterday, the content will be fresh and we have plenty to cover off. We will also be discussing the importance managing interest rate risk and show how NAB can provide support and certainty in the current market environment. There is allocated time for questions after we hear from our guest speakers. Feel free to type them into the Q&A box within your Zoom platform, and we can look to cover them off towards the end of the piece. So to kick off our session, we will hear from Tapas Strickland. Tapas is our Director of Economics and Markets. He is a regular contributor to our daily podcast, NAB's Morning Call. He's now based in Sydney, having spent some time in our London office. Tapas offers his expertise across our broad spectrum of clients, both in Australia and overseas. He previously worked at the RBA for 6 years and was an economic advisor for the Department of Prime Minister and Cabinet. During his time there, he advised the Gillard, the Rudd, and the Abbott governments. So it's fair to say he is well informed on today's subject matter. And without further ado, I'll hand you over to Tapas.
Thanks, Jack, and good morning, everyone. What a dynamic time in markets it has been, and the narrative around rates has shifted quite dramatically over the past 6 months. The RBA met yesterday and seemingly has opened up the path towards hiking rates sometime this year. NAB currently expects the RBA to hike the RBA cash rate in November 2022 and then pretty swiftly lift that target cash rate closer to 2.5% by the end of 2024. So I think it is quite clear the inflation pressures in the economy and that the RBA is reacting to those inflation pressures. Could I have the next slide, please? This is all taking ground in the backdrop of inflation picking up right around the world, not only in Australia. Part of the reason why inflation is picking up and has been more persistent than a lot of central banks were thinking about were because of the Delta and the Omicron waves of COVID-19. They have really impacted global supply chains, and we're starting to see that inflation coming through the data at the moment. And central banks, I think it's fair to say, are pivoting pretty hawkish after being surprised about the persistence of inflation. And if you cast your minds back to last year, when RBA Governor Lowe was saying rates are going to be on hold until 2024, if they do hike towards the end of this year, as we're expecting, that is quite a significant change to the interest rate outlook there. Of course, when you look at equities in the US and risk assets in general, they're starting to react to that changing interest rate environment. And the S&P 500, I think, closed January down by around 5.3%. There's been some pretty sharp falls in terms of the tech stocks as well. And hopefully today I'll cover off on a little bit of that as well. In terms of Australia, I think the Australian economy has been recovering quite sharply over the past 2 years since the initial pandemic. The unemployment rate is at 4.2% and is at its lowest level since August 2008. I think that's just worth reflecting on. The only time we've had an unemployment rate below 4% was back in the 1970s. I think in that environment, the risk is that inflation picks up a little bit more than what policymakers are thinking at the moment. And for many of you across your businesses, I'm sure you're seeing the input price inflation and you're probably starting to pass that on to your customers as well. I think we can broadly say policy settings in Australia and indeed globally are probably inappropriate for where we are at the moment. And in that light, central banks are likely to hike rates relatively quickly. So in terms of a market perspective, I think the three key conclusions we can draw from today's presentation that I'll delve into is the first one is the low point in the interest rate cycle is clearly over. The question really is now, how high and how quickly do rates go? NAB's view is the RBA will start hiking rates in November of this year, and that they'll get to around 2.5% by the end of 2024. The RBA's rhetoric is still trying to lift wages growth towards that 3% plus level. I think the persistence of inflation will cause them to buckle and will cause them to hike rates towards the end of the year. And just in terms of where rates end up, just worth noting that 2.5% is still a rate that is a lot lower than what we did see in prior hiking cycles. And I'll go through some of the factors around that as well. Could I have the next slide, please? This chart here really summarises the dramatic change that has occurred over the past 6 months. The table there shows you the RBA's forecast as at August, November, and February as of yesterday. And the key one there is the CPI, so the core CPI. The RBA back in August was thinking the core CPI rate was going to be fairly subdued, averaging around 2 to 2.25% over their entire forecast horizon. Instead, we got Q4 CPI data a couple of weeks ago, and it said core CPI is running at 2.6%, so running well above where the RBA had previously thought CPI would be running at. And indeed, their updated forecast suggests CPI is going to be running at a little bit above the midpoint of the 2 to 3% inflation band. A key reason for that is obviously the supply chain disruptions that have been occurring, but also the tightening in the labour market that has been occurring. So as I mentioned before, the unemployment rate is now at 4.2%, the lowest since August 2008. You have to go back to the 1970s to have an unemployment rate lower than 4%, and the RBA is forecasting the unemployment rate to get to less than 4% by the end of 2022, and to 3.75% by the end of 2023. So I think in that environment, you do get that lift up in wages pressure there. So in terms of the RBA meeting yesterday, the two key takeaways was the RBA kind of indicating that they could start to hike rates at the end of 2022 or the early bit of 2023. The second one was ending QE, so they're no longer buying government bonds as of the 10th of February, and also actively considering what they will do with those bond holdings, and further information on that will occur in the May meeting. I think that's quite important because if the RBA starts to wind down its balance sheet, that may mean the hiking cycle may not have to be as steep as previously feared. Could I have the next two slides, please? The key reason why markets are pricing central banks hiking rates and hiking rates quite aggressively, indeed why NAB has brought forward its RBA view as well, is just how much core inflation there is right around the world. This chart here shows you core inflation for a number of different countries, less the central bank targets. So in the US, core inflation is running 2.9 percentage points above where the US Federal Reserve wants it to be. In New Zealand, it's running 1.2 percentage points above, and in Australia, it's running just slightly above the midpoint of the target band. Right across the world, you're seeing that outbreak of inflation, and we see no reason why it's not occurring in Australia. Could I have the next slide, please? And indeed, in Australia, you're starting to see the same rates of inflation as you're seeing in many other parts of the world. This chart here shows you the RBA's core preferred measure of inflation, the trim mean inflation, on a 6-month annualized basis, and it's running at 3.5%. You compare that to the rates of inflation that are occurring in the US in terms of the Dallas Fed trim mean measure, and it's fairly similar. The Dallas Fed trim mean measure is running at 3.9%. So Australia clearly is not an island in terms of inflation. Could I have the next slide, please? The other factor that's driving inflation and perhaps has made inflation a little bit more persistent is the Delta and Omicron waves of COVID-19. We all know about how expensive it is to ship things right around the world, and going back a couple of years ago, it was probably only costing about $2,000 a container to ship, whereas now it's costing anywhere between $8,000 to $10,000 a container. Importantly, those COVID-19 outbreaks really disrupted those global supply chains, particularly in Asia, and in China, they're still running a zero COVID policy. So basically, whenever they get a COVID case, they lock down and tighten up restrictions in that area, and that has disrupted a lot of the manufacturing production, a lot of the shipping that is occurring out of China. Importantly for China, though, there's no indications yet that deviating away from that zero COVID policy. I think a lot of it will be dependent on their vaccines and how quickly they can roll out mRNA vaccines in their own country. It looks like that may not occur until the middle of this year, and so you may not actually get a substantial easing up of supply chain pressures until mid to late this year. So all that inflation impetus that is coming from higher import costs, coming from higher freight costs, is likely to continue for a little bit longer yet. Go to the next slide, please. The concern for policymakers in that environment of higher costs coming through the supply chain is that businesses and consumers start lifting up their inflation expectations. And ultimately, although those supply chain disruptions will eventually prove transitory, although it may take a number of years to work out, if it gets embedded into inflation expectations, then they could actually become a permanent feature of the inflation outlook. And we've been looking at US inflation expectations quite closely. And it's worth noting inflation expectations for both consumers and economists are now back to where they were prior to the global financial crisis and are actually above their long-run average levels. So that is suggesting a little bit of a danger that consumers are starting to demand compensation for those high costs out there, and effectively how they will demand that is through higher wages. So all those temporary higher inflation prints are translating into higher wage demands. And one example of that in Australia, the electrical trade union movement last year secured pay rises of a little bit over 3% in most of their enterprise wage agreements. Importantly, that 3% wage increase wasn't only for next year, it was for the next 3 years. So that does suggest that those supply chain disruptions or the high headline inflation is leading to consumers demanding higher wages, and that will support a more durable lift in inflation as well. Can we go to the next slide, please? The other factor to consider regarding interest rate policy from central banks is the political contest around inflation. And the reason why I bring up this chart here is my colleagues in the US tell me the number one story that is going around in terms of politics is inflation and how President Biden is responsible for the lift in inflation in the US. Now, that's not quite right, but he's seen as not having done anything to help stem the lift in inflation in the US. And as a consequence, you've actually seen the approval rating for President Biden fall quite sharply, almost back to where it was for President Trump. Why I bring this up is this is one of the factors that is starting to tilt policy more towards that contractionary territory, particularly for monetary policy, but also for fiscal policy as well. And can we have the next slide, please? And indeed, when you look at US politics in terms of voting intentions, and this one here just represents betting markets where they think the polls are going, former President Trump is in prime position to be the next US president. And in fact, betting markets describe a better probability of former President Trump winning a 2024 election than current President Biden. If you add up all the Republican runners, they are polling well above where the Democrats are polling at the moment. So this is clearly a political headache for the US. And I think in that environment, you will get pretty aggressive action coming from US Federal Reserve in terms of hiking rates. Could we have the next slide, please? And of course, markets are seeing what central banks are saying and are also fearing that lift in inflation, have started to lift up pricing for rates. And indeed, the Australian 10-year government bond yield currently trading around 1.94%. If you recall, just a couple of years ago, it was trading closer to 1 to 1.5%. So rates have risen quite a lot on the back of expectations of central banks hiking. And I guess the key question really is how high do central banks hike rates, and have markets underpriced how high central banks will hike rates? And in effect, is there still value in terms of managing risk in that environment? And I'll let Tracy talk about that later, but just to give you some illustration in terms of where markets are pricing, on slide 12, sorry, the next slide, please. This chart here shows you where a chart of the US, where the US Federal Reserve thinks rates should be in a longer run sense. That's the black line the Fed plot. They suggest rates should be around 2.5%, and that's where they think the neutral rate is. So basically where policy settings have a neutral impact in terms of the economy and in terms of inflation. A few different market proxies for where markets are pricing that kind of neutral rate or terminal rate is shown on this slide. And one of them is the 5-year, 1-year forward OIS swap. And that's currently sitting at 1.75%. So there's another 75 basis points there, at least, gap between where markets think the Fed will take rates and where the Fed thinks they will take rates. And I think that will be an interesting gap to watch over the next couple of months. Can we go to the next slide, please? Now, of course, just given how high inflation is, in the US, headline inflation is running around 7%. Central banks may feel like they need to lift rates beyond neutral and into restrictive territory. So actually needing to have to cramp down the amount of demand in the economy to bring down inflation pressures. To give you some idea of where central banks may be thinking where restrictive territory is, this chart here gives an illustration of a hybrid Taylor rule that was used by former Fed Chair Janet Yellen. And that suggests the appropriate stance of US policy is probably a federal funds rate of 2.9%. That's obviously above that 2.5% neutral rate that I was just talking about earlier. But it does suggest that there is the risk that central banks tighten beyond neutral in this environment. Could we have the next slide, please? And then in that environment, Australian rates markets have been pricing in the risk of the RBA lifting rates. And on current pricing, markets pricing in almost 8 to 10 hikes within the next 2 to 3 years. So that's quite an aggressive rate hike path, but that's broadly appropriate in our view. And indeed, in NAB's view, by the end of 2024, the RBA cash rate would be probably closer to 2.5%. Could I have the next slide, please? The next slide, thank you. And then just in terms of the Omicron variant and its impact on global activity, I appreciate many of you who are on this call have had their business operations disrupted by the Omicron variant in Australia. The good news is that it looks like Omicron peaks relatively early. It's just so virulent out there. It looks like it has less mortality and less rate of hospitalizations compared to other waves of the virus. This chart here shows you COVID patients in hospital in South Africa, the UK and Australia. And the key thing is just the peak has occurred both in South Africa and the UK. In Australia, it looks like it is peaking and starting to trough now. So in the next month, the conversation will definitely turn towards how to get activity back up now that we're past the peak of the Omicron wave. Another factor, and if we could have the next slide, please, is the rollout of booster shots. So in Australia, we've rolled out booster shots to about 30 to 35% of our population. And indeed, the booster shot that we have rolled out so far is actually higher than the number of booster shots as a proportion of population given out in the US. So we're pretty much on our way in terms of starting to live with this virus. And indeed, the political decisions that were made by state premiers has been towards living with the virus. If we can have the next slide, please. As more people get infected with Omicron and as more people get a booster, people are starting to resume activity after that kind of self-imposed kind of lockdown feeling that some people had at the end of December and early January. This chart here shows you Apple mobility search data. So if you have an Apple phone and you use Apple Maps, every time you search, this is what this data is picking up. And those searches really troughed around the 8th of January and have been picking up ever since. And I think that is consistent with what I have been seeing in the CBD of Sydney as well. I've been at work for a little bit. In early January, it was very quiet in the CBD area, and now you're starting to see more people to CBD areas as well. So all that points towards a fairly short, sharp disruption from Omicron in terms of business operations. And if that plays out, that will be very good for the Australian economy. But the impacts on the supply chain are likely to be a little bit longer lasting, particularly because China is running that zero COVID policy. And so the way we're viewing Omicron is it's likely to impact inflation more than it will impact activity. And that definitely has implications for central banks. If we could go to the next two slides, please. So coming back to the Australian economy, part of the reason why the rhetoric around rates has changed so dramatically over the past 6 months is just exactly what's going on in the labour market. So the unemployment rate is currently sitting at 4.2%, and that is its lowest level since August 2008. And you have to go back to the 1970s to get an unemployment rate lower than that. The dotted lines and the blue line are the RBA's November forecast. So they've updated those forecasts subsequently, but I think it's just worth reflecting that the unemployment rate has dropped well below where the RBA was thinking, and is running about 12 months ahead of their November forecast of last year. The RBA now thinks the unemployment rate will get below 4% by the end of 2022, and will get to around 3.75% by the end of 2023. In that environment, I think wages growth will start to tick up quite a lot. If you could have the next slide, please. So in terms of indicators for the labour market, they are still incredibly strong. When you look at SEEK job ads, and I'm sure many of you have placed job ads on the SEEK platform, the level of job ads in New South Wales, for example, is 36% above pre-pandemic levels. That's an incredible amount of labour demand with an unemployment rate of 4.2%. The chart on the left-hand side there shows you SEEK job ads in level sense inverted. So a decline in that pink line is actually increasing job ads. When you line that up against the unemployment rate, it all points towards an aggressively lower unemployment rate from here. So that's another positive signal out there that suggests the labour market will continue to tighten, and that will pressure the RBA in terms of hiking rate. Could I have the next slide, please? And then similarly, in regards to other indicators of the unemployment rate, they're all pointing to lower as well. In the consumer sentiment surveys, they ask one question amongst consumers: how confident are you in terms of being employed? Do you expect to be unemployed in the next 12 months? And all of that is at very low levels. So all those indicators are still pointing towards a very low unemployment rate from here. Could I have the next slide, please? Also adding towards a more positive outlook for this year, and I'm sure many of you have read this in the papers because the Treasurer has made a lot of sounding about this, is just the accumulated savings by households during the pandemic. So since the pandemic began back in February 2020, households have saved around $242 billion. Now that's equivalent to about 11% of annual household income in any given year. And to put that into a little bit of different perspective, that's equivalent to around 20% of annual household consumption, and that's saving. So that potentially could hit the economy this year, could potentially hit the economy next year. It could potentially flow into financial assets, it could potentially flow into property, it could potentially be used to offset debt. The important thing is household balance sheets on the whole are in pretty good shape, and importantly, are in pretty good shape to absorb price rises. For businesses out there that have felt a dramatic lift in input costs, then I think there is scope for them to lift end prices to recoup some of that increase in input costs. And indeed, you're starting to hear those soundings coming out from the major supermarkets and also from a number of other retailers as well. Could I have the next two slides, please? So in terms of how low the unemployment rate has to get wages growth closer towards where the RBA would want it. So the RBA sees wages growth needing to get to 3% plus in order to be consistent with inflation averaging around 2 to 3% over the cycle. Our modelling suggests the unemployment rate needs to get to about 4%, and then you start to get towards that neighbourhood level, which theoretically is a tight labour market that then starts to see employers bidding up the wages of employees. The unemployment rate is at 4.2%. So I think it's quite likely that you start to see that lift in wages growth in the coming quarters from here. Could I have the next two slides, please? One reason why the labour market is so tight and why job ads at such unprecedented levels is because of population growth and our semi-closed international border. So Australia's population used to grow by about 400,000 people a year, and at the moment it's only growing by about 50,000. So a dramatic slowing in population growth because of that closed border, and that's primarily due to net migration turning negative as more people left Australia and came to Australia, and that's created a lot of labour shortages right around the economy. Not only in the highly skilled sectors where it was quite common to get, say, the old 457 visa holders, but also in the lower skilled areas such as hospitality and agriculture, which used a lot of backpacker and student workers as well. So I think it's going to take a little bit of time for population growth to return. So for at least this year, I think those pressures around wages will continue. Could I have the next 2 slides, please? So in terms of more specific inflation pressures in Australia, NAB surveys around 400 businesses a month, and we ask them a number of questions in terms of labour costs, whether prices are going on the retail side and purchase costs. And that's what this chart here shows. The important takeaway is retail prices and purchase costs are at almost record high in terms of percentage changes. So I think it's quite clear that you're going to get some pretty strong CPI prints in the coming quarters. And I think that forces the RBA's hand in terms of hiking rates. And we'll pencil it in, obviously, November 2022 for that to occur. Interestingly, labour costs haven't risen by as much as you're thinking in comparison to their long-run average levels. But we'll be looking at that quite closely to see whether you're starting to see a broadening out in those wage pressures. Could I have the next slide, please? In terms of what's driving inflation in Australia, we've been doing a little bit of work in terms of just summarising the main drivers into just a few components. And the key one really at the moment is new dwelling construction costs. And for any of you who are in the building game, obviously construction costs have increased quite dramatically over the past couple of years. The first one was largely due to the home builder grant, so a large pull forward of housing demand. And the second one is all the supply chain disruptions that are going around right around the world, really hampering the ability to get building material into this country. We think that continues for at least another two quarters, and it should start to ease back from here. The other area that has been driving inflation is in terms of imported components. So that's kind of proxied by furniture, so that's adding to inflation. And then labour services, you're starting to see a pick up in terms of the pricing by, say, hairdressers and those kind of things that proxy for wage costs within the CPI basket as well. And then the other factor I just wanted to highlight why we think inflation is likely to be a little bit more persistent in Australia than what the RBA is thinking is rents. So rents in Australia are not really adding to CPI. That's primarily due to the rental declines that we saw in Sydney and Melbourne, particularly in the unit market, and that's from the lack of migration. You're starting to see advertised rents pick up, and I think advertised rents for core logic amongst the capital cities in Australia is running at 9% year on year. And then if we do open up our international border more fully, and we haven't built that many new apartments, it's likely you're going to see a very aggressive tightening up in the rental market. You're going to see an increase in rent. So we think rents will drive will drive inflation to be more persistent than the central bank is actually thinking at the moment. And that's part of the reason why we think the RBA continues to lift that rate towards that 2.5% level towards the end of 2024. Could I have the next slide, please? And then just in terms of how surprising the recent lift in inflation has been, again, I've got the RBA's forecast from November, and I've got our own forecast, NAB's forecast from November as well. And just worth noting, core trim mean inflation at 2.6% year on year has blown out all those forecasts out of the water. So we're in a very different environment than what we thought back in November from a policy sense. And in that environment, policymakers are likely to become relatively hawkish. Could I have the next 2 slides, please? Could I have the next slide, please? Apologies, I think we're having just a little technical problem here. And the next slide as well, sorry. And in that environment, Australian financial markets are pricing in 8 to 10 rate hikes by the RBA over the next 2 to 3 years. So in terms of where rates go, or in terms of how high they go, I think that is the ultimate question at the moment. It's quite clear we're past the low point in the interest rate cycle. Very clear that rates are going to rise, and exactly how high do they rise to? So I mentioned in the US that the US Fed thinks their neutral rate is probably around 2.5%, and that to get into restrictive territory, some of the old rules of thumb that previous Fed chairs used were suggesting a rate closer to 3%. In Australia, we've done a similar kind of exercise. So we've replicated a lot of the RBA work in where they think the Australian neutral rate is. And we think the RBA thinks the Australian neutral rate is probably around 3 to 3.5%. Now, we think that's a little bit too high. And we've been doing a little bit of work in terms of the interest servicing costs for households. And if you lift rates by about 175 to 200 basis points, that lifts average interest servicing costs back to their long run average levels. So for us, we think neutral in Australia is probably around that kind of 1.75 to 2% level. But because we see inflation being more persistent in Australia, particularly due to the rents factor that I mentioned previously, that's likely to emerge towards the end of 2022 and into 2023, we think the RBA will actually go into restrictive territory relative to where we think neutral is. And for us, restrictive territory is probably around that 2.5% rate there. I'm just very conscious of the time, and I might leave it there. And I just want to say thank you again for your time, and I'll hand it back to Jack. Thank you.
That's fantastic, Tapas. Really appreciate your efforts and input there, especially given that the RBA meeting was less than 24 hours. So it was a stellar job. Also, just a reminder to our participants that if you do have any questions, please feel free to just jot them into the Q&A box. We will come back to you and address them later in the webinar. For now, now that Tapas has set the scene for the rate environment over the coming years, I would like to introduce our second guest speaker, Tracy Ferguson. Tracy is NAB's State Director for New South Wales Business Markets. She leads a team of financial market advisors that cover interest rates and foreign exchange. Happy to say that I'm part of her team. Tracy has extensive experience in the markets, having spent time in Australia and New Zealand. She has worked as a trusted advisor for business and corporate clients in both the metro and agribusiness space. Today, she will present how businesses can protect themselves against unfavorable rate moves and review potential hedging solutions. So over to you, Tracy.
Thanks, Jack, and thanks, Tapas, as well. Wow, what a 12 months it's been. Who'd have thought over 12 months ago when Governor Lowe was talking about interest rates on hold to 2024, now we're facing into a very, very different rate cycle. And as Tapas has brought to our attention, discussion now moves towards the low point in the rate cycle has gone, both obviously from a long-term perspective, and certainly we're starting to see potential impacts to cash rates as well. But how high and how quickly will those rates move? And today's session with Tapas was all about giving you the economic and macro impact of that. My team here, and as our national markets team, are here to support the relationship managers in understanding how does interest rate risk impact your business? Will the next interest rate rises over the next 2 to 3 years? Are you able to pass those costs to your customer base? We're not here to sort of say rates are going higher or lower. We're here to say what risk do you suppose, and have you make an informed decision from there. We'll go to the next slide, please. So why is interest rate risk management, and all banks, we love a good acronym, so for short, why is it important for you as a customer? For many clients, interest costs are one of their biggest expense. And as we've talked about, that expense looks like it's going to get more expensive over the next couple of years. Having cash flow certainty helps you plan and budget in your business and takes the uncertainty out of your cost basis. There's a lot of talk around economic events and forecasts at the moment. Our market specialists are here to talk you through what does that mean for your business. It allows you to focus on your core business and not interest rates, As exciting as watching interest rates on a day-to-day basis, let the markets team manage that for you. And obviously impacts any unknown risks on your company results. So summarizing, it helps you manage your costs. So what risks do borrowers face? We've spoken a lot today about the RBA and the cash rate and the transmission of the RBA in its monetary policy settings and how that flows through to the cash rate. So the cash rate is obviously the rate of which banks lend to each other, and the Reserve Bank influences that through its open money market operations. BBSY, which is a benchmark wholesale rate, is closely correlated to the RBA cash rate. There are a couple of other things that impact your borrowing costs. So the rate that you see your loans draw down at. So obviously we've got RBA, BBSY. So that's an increase in rates due to the RBA changing its rate forecast and market expectations. An example of that would be, if we think back a couple of years ago, pre-COVID, the RBA was on hold due to supply and demand in the market. BBSY was actually moving higher. So that BBSY benchmark wholesale rate can move very independently of what the RBA is doing. So that's one input to your borrowing costs. Another input to your borrowing costs is term funding facilities. So that's how long we lend funds to. And if you think about how a bank raises funds, a couple of things it looks at. What is its deposit base? So how much deposits does it have? Banks have been awash with cash. You saw that the chart that Tapas put up. So we haven't had to go to offshore markets to raise funds. As you start to see a movement of that cash into other asset classes, obviously that could potentially can have impacts on raising the cost of funding into market for banks to raise funds as well. And giving you an example of that, 2 years ago at the start of COVID, we saw credit spreads move out quite considerably. So that's another unknown cost that we can help you manage. And the third one is credit risk. So that's something that you as a customer have control over. So the changes in your customer margin, all based around your risk profile. And typically that relates to things around the security profile that you have, the loan value ratio. So that's something that you can control. Our market specialists are here to help you mitigate the facets of that interest rate risk. Next slide, please. So why manage interest rate risk? Today, it's all about controlling the controllables. What can you control in your business costs? What can you have control of? Do you have an asset that has a fixed income stream on it? So you want to manage the costs that are involved in that. So again, our market specialists will talk to you about your business considerations and align your interest expense to your income stream, talk about the certainty around your interest stream, and give you what is your known borrowing costs, the things that we spoke through before. Next slide, please. Risk neutral. I really love this slide. You know, often when we talk to customers, we hear conversations around, I'm going to either be 100% fixed or I'm just going to remain completely floating. There is a balance in there between, and that really comes down to what is your risk profile. So a balanced hedge ratio that gives you some fixed and some variable, depending on how much certainty and how much risk that you want in your business. So for example, if you have 50% hedged, so you're protected against interest rates moving higher, and 50% remains floating, so it gives you some downside certainty as well, or allows you to reduce some debt if you need to, gives you a balanced portfolio approach. Or you may be a customer that wants to move a little bit further towards the 100% hedged ratio. Again, your market specialist will have this conversation with you based on your individual personal business profile. Or you may choose to remain 100% unhedged, and that's okay as well. Our role is to manage the risk for you and to give you the tools to make an informed business decision. Next slide, please. Cash rate forecasts. So we've spoken a lot today about NAB and its forecasts. As a manager of risk, we want to give you the full picture. So what we've put up here is just a slide that shows you the current 4 majors and their 3-month BBSY forecasts for the next 10 years. Now, I'm not saying NAB's right, or Westpac's right, or CBA's right, or ANZ is right. I think this gives you a very clear picture of the divergence of views at the moment. So again, if this is concerning you and the impacts to your business, our market specialists can talk you through how do we help you manage that risk. Next slide, please. So again, we've spoken about the low point in the rate cycle. How high and how quickly rates move is the next consideration in talking through the risks that you're exposed to. I think it's definitely worth looking at, though. We are actually still at a relatively low point in the current interest rate cycle for 3 and 5 year rates and beyond that. So it's hard to sort of think about that in terms of where we've been, but again, there are still market opportunities there to talk through to your specialists. Next slide, please. So NAB Markets, why us? We're a team of national specialists and we work closely with our relationship management teams. So we're locally based. We'll be able to provide you expert insights and be able to manage your risk. Next slide, please. So from today, if you require any further information or you want to have a tailored personal discussion, please reach out to your NAB relationship manager. And we've put a contact up here from our markets team who will be able to get in contact with the local market specialist as well. But please, we'll and also post a copy of this presentation after the webinar as well. So I hope today's been informative for you. Thank you again, and I'll hand back to Jack.
That's great, Tracy. Thanks very much for all that information. There's obviously a lot for clients to digest. And once again, for everyone who wants to have a bit more of a specific chat, as Tracy mentioned, please reach out to your banking relationship manager, and one of our financial advisors will be really happy to have a more specific chat around your own business. But just a couple of points. A lot of people have asked whether we'll be presenting the slides and that, and we'll send through the recorded webinar in due course. But at this stage now, we will look to move on to the Q&A piece. So I'll ask Tracy and Tapas to come back on screen. So we've had quite a few questions. There you go, Tapas, thanks. Come through, which is great. So just maybe starting off, directing this one at you, Tapas. The question regarding, given the significant rise in rates by end of 2024, how do you anticipate this would impact the pricing of asset classes such as equities, fixed income, property?
It's a very good question. You'd have to say markets are definitely in flux at the moment, and those falls in the stock market that you're seeing is some kind of adjustment towards a higher rate environment from here. I'm not a specialist in terms of the equity market, but I would just observe that you do have price to earnings multiples at relatively high levels. You would have to say the earnings profiles of most of those companies probably hasn't changed over the past 2 years. So a lot of it has probably been through multiple expansion. So in a higher rate environment, then you're likely to see more people questioning valuations in that asset class. As for bonds, obviously yields lifting. And the key question really, as Tracy was talking about, is how high do central banks hike rates? So 10-year yields tend to trade or tend to peak at where the terminal rate is for central banks. And at the moment, in the US, at least, the market is pricing a terminal rate of about 1.75. So that's basically where you've got that US 10-year bond yield at. But just worth noting, the US Fed thinks their neutral rate is at 2.5%. And when you use those other rules of thumb in terms of how tight policy needs to be, just given how high inflation is, then you're talking about a Fed funds rate closer to 3. So I think in that environment, I think the risk is that you do see a continued sell-off in bonds. You do yields rising a little bit further from here as well.
That's great, Tapas. Thank you. So for the next question, I'll direct it to you, Tracy. So the question is, depending on the length of fixing a rate, is there much of a difference between the short and longer term?
In terms of, so the term to maturity profile of interest rates is going to affect the price that you get. It's at the outright price that you get. I mean, really, and that's a function of market expectations of interest rates as well. The question is, what is the asset that you're trying to protect? Again, as we spoke to before, what is that asset that you're trying to protect? What income do you have on that asset to sort of protect your income and borrowing costs? And does that match up to your funding profile as well? So typically in a rising interest rate environment, you have a positive yield curve. So short-term rates are low, and as rates move higher, so 2, 3, 4, and 5, you start to see a higher rate environment. And obviously, there's potentially at the start of a tightening cycle. So we're seeing a bit of what we call steepening of interest rates. Depending on how things go, that may start to flatten out a little bit. But at the moment, our core view is that we'll continue to see a higher rate environment. So have a discussion with your market specialists on how to structure a transaction that best suits their needs.
Excellent. Thank you, Tracy. So with the next question, I'll bring it back to Tapas. And will a low rent increase mean a more competitive market, a competitive apartment market? And what do you see the impact being on competitive pressures on developers with the flow through to builders, contractors, and suppliers? So specific to the residential industry there.
Yeah, it's a good question. So in terms of rents being low, I guess that has been the feature over the past 2 years, particularly in inner city, Sydney and Melbourne. But the key point I wanted to illustrate in the presentation is that you're starting to see advertised rents actually increase. So you're seeing 9% rent increases in terms of advertised rents across the capital city. So for me, I think the low point in terms of rents is also over, and I think you're starting to see that tightening up in the rental market from here. And then in terms of how developers respond to that, obviously there will be a little bit of gap between when developers and builders realise rents are starting to rise again, that demand for units is rising, and when they start to enter the market again and start to build and construct it again as well from there. And so that's part of the reason why I think the rental market tightens up pretty aggressively in 2023 and 2024 as well. In terms of construction costs, obviously has been sweeping through the building industry and has definitely seen a few builders and developers who focus in terms of fixed costs construction contracts hit a little bit of trouble there. And unfortunately, I don't really see those building costs really easing back until the second half of this year.
Okay. So and maybe just conscious of time, we'll have the last question directed to Tracy. And the question is, Tracy, is there flexibility with regards to the hedging that I can look to implement?
And hedging's not a gardening tool either. I quite often hear that word, and I wonder if clients think that that's a gardening tool. So it's how you manage your risk, and certainly there is flexibility. It all comes down to, again, the individual business and what percentage of a fixed, whether that be within a fixed, traditional fixed instrument or an interest rate cap, or they may want to have some floating, or they may want to have a different range of terms as well. So the beauty of the NAB funding product is it gives you that ability to have various components within your interest cost. You end up with a weighted cost there. So again, our interest rate specialists will be able to have that conversation with you.
Perfect. Thanks, Tracy. So it's a kind of a specific to clients' needs, etc.
Absolutely.
So Excellent. Well, like I said, unfortunately, we'll probably have to bring it to a close today on the Q&A piece. There are a few others in the forum, but I'd like to, we will ensure to actually come back to those offline as well in due course. So that'll come out as well with the recording of this piece. So thanks again, thanks to our guest speakers. Really appreciate the insights and expertise on the matters. I know Tapas has to run off now because I think Governor Lowe has a conference at 12:30, so no rest for the wicked. Yes, so just bring it to a close. The one final request from our participants today registered. There will be a short survey once you exit the webinar. If you could provide feedback, it would be really appreciated. It will enable us to, I suppose, to continue to improve and enhance the services that we're looking to provide to our clients. And I suppose that is the end. We'll bring it to a close today as it's heading towards that midday time period. So once again, thanks very much for participating, for engaging, and choosing NAB as your banker moving forward. And we'll best of luck with everything in the short term and the long term in these times ahead. So thanks very much.
Thanks all.